Central banks have hiked interest rates around the world over the past 18 months as they moved rapidly to tackle high inflation. The good news is that inflation has been falling, but resilient growth has raised concerns that this rate hiking cycle isn't over yet. Importantly, we're seeing significant regional divergences. This is exactly what we expected to see as interest rate cycles re-emerged, but it's been interesting to see the cross-currents being felt after such a long period of regions moving in unison. The US economy is still a little too hot for comfort, while China is struggling with a weak property sector. Japan has been soaring because of the dovish stance of the Bank of Japan, while Europe risks another recession. As we've outlined in our medium-term roadmap over the last couple of years, we expect inflation to be structurally higher owing to a number of trends such as labour scarcity, a shortening of supply chains, and the energy transition. We've broadly categorised these as the 3 Ds of demographics, deglobalisation, and decarbonisation. We then overlay this roadmap with a more cyclical view based on the stage of the economic cycle. In this regard, we believe we are reaching a plateau, more like Table Mountain than the Matterhorn, as the Bank of England's chief economist described it. This comes as central banks observe the impact of their rate hikes so far and see signs that inflation is moving in the right direction. Earlier in the year, we accepted that the US economy was proving to be more resilient than we had expected. As a result, we closed our underweight position in equities and have now moved to a tactically positive view on US equities as we go into year-end. We expect bond volatility to stabilise, and given that the US economy is still generating positive growth, we believe that the soft landing narrative can allow US large cap stocks to deliver further gains. We remain positive on Japanese equities given the Bank of Japan's stimulative stance, but we're negative on German equities where the economic slowdown is gaining some momentum. In summary, we're exploiting regional divergences in our equity views. Equity styles are harder to discern. On the one hand, a higher interest rate environment should support value stocks, as near-term earnings tend to become more valuable at such times. But on the other hand, technological disruption continues to be a powerful force and supports growth stocks. Looking at fixed income, we expect yields to stabilise as inflation subsides, but given that we are not expecting an imminent recession or a Fed pivot, it seems too early to buy government bonds today. In summary, we are focused on tactically capturing anticipated market upside into year-end, taking advantage of regional opportunities with equities, but we need to keep a close eye on which way the wind is blowing in case growth does start to slow faster than expected.